Hello, everyone. My name is William Mucker. I am a client executive with Camoplan and would like to thank you all for joining us for today's webinar, The Self-Storage Freight Train and Why It Thrives During Recessions, with Scott Dahan and Scott Myers of Tricor Investment Group. As a quick note, please be aware that Scott will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen in the chat to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camoplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camoplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'll pass it over to you.
All right, gang, Scott Myers here along with Scott Dahan, just making sure, William, can everybody see and hear us?
Looks great. Sounds great to me.
Okay, fantastic. Well, let's see here. And do you see the presentation? Is that what is pulled up right now?
Yep.
Fantastic. All right, gang. Well, again, apologies. On behalf of all of us with our technical difficulties and starting just a little late, good morning and good afternoon. We are here representing the Tricor Storage Fund and talking about the self-storage freight train and what we consider our favorite asset class. But as William mentioned, we are not here to really promote any one thing or any one investment. This is an asset class that Scott and I both love because of what self-storage is. It is a simple, predictable business model that does extremely well during good times and even better during a recession. It is not the most glamorous, or some people would say not the sexiest asset class in all of real estate. But what is attractive to us and sexy is cash flow. And the fact that this is an asset class that does not have tenants and toilets and trash. However, people do rent our units. We have all of the benefits of real estate, appreciation and depreciation, and it performs better during the down times as well as during a good time. So that is why we find it attractive. So with that, Camoplan has asked us to come share a little bit about the industry, our background, and the reasons why we like it, and a little bit about what we do in the industry as well for folks that are looking at maybe some different asset classes in real estate right now. And so self-storage being one of those that has been in the news quite a bit recently and has done extremely well, not only, again, during past recessions, but also what's considered call it a mini recession. What we saw during the pandemic is kind of what we see during a recession. You know, we are in the trauma and transition business in self-storage. And when businesses shut down and people had to come home from school, or people lost their jobs, or people came home to work, all of those things necessitated a need to move things out of the formal dining room or the spare bedroom to create an office, to create a school. Many people lost their jobs, or things were tough and they had to move back home or move in with somebody else and put extra stuff in storage. All of those things and more are what drives the demand for self-storage. And so it is a needs-based business. And again, we don't celebrate pandemics, we don't celebrate recessions, but our industry does tend to benefit more than others when we fall upon those hard times. And so as we see, Green Street Advisors tracks the various real estate asset classes in a commercial, and showing that as usual, as it always does, self-storage at the top of the heap in terms of returns, either least affected during a recession or most profitable during both recessions and boom times. And that is why we see public storage was set to sink $1 billion into buying more properties in 2022 and 2023. And that freight train has not stopped, and the merger at the top with the multiple REITs as well. And so that's what we're going to be talking about today. So in terms of my background, I'll let Scott speak to his in just a second here. Come from Indianapolis. I have an amazing wife and 3 amazing kiddos, and they have 1 average dog. I've been in real estate in the single family side and the multifamily side since 1993. bought, converted, and developed 15,000 units and over 2.5 million square feet. Together, Scott and I combined now, we are over 25,000 units and over 4 million square feet that we have worked on collectively. We've raised over $60 million from our 400 plus private equity partners from many areas and doing the same things, as well as from Camaplan that are using their self-directed IRAs to invest in our funds and in our private placements as well. Scott and I speak for the ISS, the SSA. We write for Forbes magazine, the various magazines, and also host the self-storage podcast. I founded a national self-storage coaching business, and Scott assists in that, as well as our mastermind as well. And we formed our business at the heart of it. Our DNA is giving back through multiple charities, but what we mainly do is build houses in Mexico and the Dominican Republic, and we give them away. We've been at this business for a while. We learned from the recessions in 1999 and 2008, and we can't wait for number 3. So depending upon where you feel that we're at right now, whether we're in a recession or heading into a recession, we know that self-storage is going to do well. And that's we are poised to, again, not take advantage of in the marketplace or of people, but we know that there's going to be some troubled assets coming into the market in the third and fourth quarter of this year. We're already starting to see that. And the Tricor Storage Fund has been very opportunistic in raising capital and preparing for that. So with that, Scott, I will let you introduce yourself and fill in the gaps.
I think you put it pretty well yourself. Thanks, Scott. Yeah, I think, you represented a good amount of things we're involved in. I started off as a commercial real estate broker specializing in storage. So I learned it from the underwriting acquisition side, but then quickly bought properties and managed a lot of them ourselves. So I would go, collect rents from the managers or go sit there when they were sick. And so I've been in the trenches as well as now managing, 60 million plus in equity. So, it's been a fun ride, and we've grown it, very organically over these years, and can't wait to continue to grow it. And we've seen through those recessions that it's just resilient. Like you said, we like tumultuous times, because of the moving. As a person, we might not like it, but as a business, it's a commodity space that is really good and recession proof or resistant at the very least.
Mm-hmm. Absolutely. And so why self-storage and why now? Well, we just saw that the pandemic created a surge in demand for self-storage as people came home to do work and school. The industry benefited greatly and has continued to do so. And now what we're seeing is the lingering effect of the COVID hangover in terms of how people are working and moving and utilizing storage is that they recognize employers recognize that when people came home to work, that it worked out pretty well. They may have been slow or hesitant to send people home to work like other companies, but then they recognize that, hey, people can work and be productive at home, and they're happier and they stay longer. And in many cases, they're even more productive because they don't have a commute and they don't have the distraction of fellow coworkers around. And so they are allowing people to work from home. And so those folks now recognize that, you know what, they don't have to live in, pick any bad city in the country that you want. If they don't want to live there, if they want to live somewhere else, or if they want to move back home to wherever home is and be near family or wherever else, we now have an even more mobile workforce, which creates a more demand for storage. We've got 10,000 baby boomers retiring daily. This has been really the huge engine behind the demand for storage over the past 20 years. And that has been as the boomers retire. Well, first of all, the boomers did very well. And so they had lots of toys. They had boats, they had RVs, they had second homes in the southern parts of the country. And so they would put their items in storage when they would spend 6 months down there, and Airbnb or VRBO, their property up north, and then vice versa when they would move back. They bought boats, RVs, campers that couldn't be stored in their neighborhood because of the HOAs that have been coming about and growing in the past several years. And so that has created a huge demand for storage. And then as they move along in life, when they downsize, when the kids move out of the house, they put their extra stuff in storage. And then when they move to assisted living, they downsize again, put their stuff in storage. And then when they pass on, then the heirs, the kids, whoever is left with those goods, they typically don't want to have sometimes the old green couch that Aunt Mary gave them. And so it goes in storage because they can't get rid of it or throw it away. There was a big fear that millennials, being minimalists, that this would affect our industry and what would happen. There's always a fear as to what this next generation is going to do or what's going to happen down the road. And all that we've seen is, and the reports is that the millennials actually have almost, I think we're sitting at about 80%, so almost double the demand for storage than the boomers did. And that's because they are more mobile. They choose to have adventures versus a house and a yard, and those adventures and being mobile means tiny houses, smaller houses, apartments versus home ownership. And adventures means camping gear, it means motorcycles, it means kayaks, you name it, that won't fit in a tiny house or a condo or an apartment. Or if they decide to live a place for 6 months and then move to Europe for 6 months, well, their stuff goes into storage, and we've seen a doubling of demand for storage by the millennials. RVs during the pandemic, nobody could go on vacation, sold out. Boats sold out. And so there's been a huge surge in demand for storage that we add on to our self-storage facilities. And Scott and I also own facilities in which they are nothing but boat and RV storage, because there's been such a huge demand in the past several years with a nationwide wait list. And so we don't see this happening anywhere else. And just as you see the graphic come up for those that are watching, we never in the industry ever want to turn anybody away. We're always advertising, and there's usually somebody moving out. But what we've seen recently is people actually putting a sign on the door or on their website that just says no vacancy. They're sold out and they got waiting lists. It's a good thing and it's not a good thing, but we're only seeing this in storage, and we're certainly not seeing it anywhere else. The Motley Fool, as you probably imagine, one of the greatest investment houses, if you will, or databases. Why self-storage is a smart buy in 2022 and beyond. We continue to just see over and over again multi-housing news. They cover multi-housing, and they're stating that self-storage is the asset class that is now come to Main Street and is the preferred asset class for the lenders, for the lending community, our banks. BizNow's recession in 2022, U.S. self-storage says bring it on. Yeah, we have been, and this is just rolled over into the first quarter and will further out the rest of 2023. We are poised and ready. Okay, so why the old article, Scott? Are you just lazy? No, this is from Thursday, July 19th from 2012. Self-storage industry outlasts the recession and outpaces REIT sector growth. History tends to repeat itself. We know what to expect. This is our third recession, and we're seeing, although every recession is different, we're seeing the same signs and being able to look a little further down the road, poised to, once again, take advantage of the opportunities that exist in the marketplace. And, well, that guy is a little younger version of him, wrote an article in Forbes magazine about 4 reasons investors should be looking at the self-storage industry right now. This is an article that I wrote at the end of last year as well, and some of those things we're going to talk about today. Well, why do we love self-storage? Well, we mentioned it's kind of like it because as opposed to other forms of rental real estate, or as he and I we both came from houses, apartments, office buildings, habitational real estate, and other forms in which if somebody has to leave, we ask them to leave. We have to go through the eviction process. Whereas in self-storage, it's just almost just the opposite. When somebody has to leave, we ask them to leave. We have lien laws, not eviction laws. And so somebody doesn't pay, we remove their gate code, they can't get into the facility. We put another lock on their unit so that they can't get in, and then we auction their stuff off to recoup our back rent and our late fees. You can't do that in habitational real estate. That is illegal. So we get paid 100% of the time. It doesn't mean that we get 100% of our back rent and our late fees, but we have at least the ability, versus going to small claims court where we have very little ability to get anybody to show up, let alone get any money out of them by garnishing their wages. So the good news is with self-storage, we are the judge and jury. There are no courts, no attorneys or collection services involved. That is all handled by either a third-party company that handles our auction services, or owners of self-storage can have their managers, or even the owners can actually perform the auctions as well. And for us, to just a little personal caveat, is the way it should be. Scott and I have charities that we give to. We build houses and give them away, but our business is not a charity. And so if somebody doesn't pay, they should leave. And if they destroy our property, they should all pay for that. And for some reason, the courts and habitation real estate feel otherwise. And also in many of our facilities, we don't do this ourselves. We can put these auctions online, and we don't have to have anybody even show up to our site. We can cut the lock off, open the door, take pictures, and put the unit online, which is a much more efficient way of doing it, obviously. And then also the greater number of eyeballs you have on the stuff that is in those units the greater amount of activity, and at an auction, it's always about the activity. So we love this asset class because lenders love it as well. And that is because lenders, their primary goal is when they make a loan is to, number one goal is to get the money back, to get the principal back, and B is to earn a return. That's number two. And self-storage has the lowest loan loss rate and the lowest default rate. So regardless of what's happening in the marketplace, whether we're in a recession or in an inflationary period, boom time, lenders love self-storage. They want self-storage on their balance sheet, and they are clamoring to do business with us, especially right now, because as we head into this next economic phase, they want to strengthen their balance sheet so that they can still get money from the feds. And the best way to do that is to put the asset class that the industry knows, this is from the Fed site, knows has the lowest loan and default rate and loss rate. And so banks improve their balance sheets by loaning money to us as self-storage investors. And so that also is another reason why we love the industry as well. Also, the ability to, not only do we rent units, but we have the ability, once we buy a facility, we focus on a lot of mom and pop facilities where we're adding ancillary income streams where they didn't. So in addition to improving the operations, in addition to leasing them up, marketing properly, we have the ability to sell locks, boxes, and moving supplies, record storage, and shredding services. We can put up a billboard if it's not there. We can also offer to have cell phone towers located on our sites. We can offer temperature control and wine storage, renter's insurance, vending machines, eBay services, pack and ship. I mean, there's just a number of ways, including truck rental and U-Haul, that is ways that we can improve and add. And this is, and I'll let Scott comment and take it from here. And this is really where Tricor shines. Our operations department, we built from the ground up. We feel that nobody can manage and drive the income and reduce the expenses as well as we can. So instead of offering third-party management, we do mini feasibility studies at each one of our sites so that we can maximize the income and reduce the expenses. So Scott, you want to take a second to talk about how we brought that back in-house?
Sure. Yeah, we all fall under a business plan that we've perfected for the past 10 years, and that's value add property, B and C class, and increasing the overall look, feel, culture, viability, bottom line of these storage facilities. And we like the Southeast, have been there. And we like the dirty properties that have some blemishes on them that we can fix up. Scott and I have both, and a lot of the team has been in, single family flips and multifamily flips in the past. And so we used what we knew about improving the general, the culture of a property, whether it's an apartment or it's a storage facility. Everybody understands that there's a culture there, right? If there's druggies, if there's violence, if there's vandalism around, those are the things that scare people away. I think it's 80% or 70% of the people that call to make a reservation for storage are women. And they want to feel safe when they go to a facility. That's one of the biggest top three reasons that people choose a certain facility. So back to that, right, is we use an overall arching business plan for our company, and then each property has its own business plan from there. And that's how we, are able to be flexible in what we do in each property to maximize the bottom line. And we don't always want to underwrite it either. We can come up with 10 different value adds, but really 4 or 5 of them are going to work better than the other 5 or 6. So, we zero in on what's the best, and sometimes it just takes getting into that property, owning it, and running it to see what some opportunities that may arise beyond those initial 10, that are listed here that we typically find at all facilities.
Mm-hmm. And again, we kind of naturally gravitated towards self-storage because as we begin to grow as a company, you recognize if you're going to grow value for your investors and the other asset classes, it's usually through occupancy and rent growth. But we're essentially, and Scott and I are both agree that we're a financial services company that deploys capital on behalf of others in self-storage. And in order to get the returns for folks, we have to have a massive, a 2x plus return. And so for buying an existing facility, we can raise rates and we can raise occupancy, but unless we have the ability to add on additional ancillary income streams, it's going to be tough to be able to get a return to our investors without them going to another asset class. The good news is we've identified over 40 different profit centers that we can add to a self-storage facility, and we found more opportunities in the self-storage industry that we can add to a facility in our portfolio, which allows us to be able to get those returns to our investors. And so again, it isn't the most attractive asset class, but for so many reasons, we love it. We don't have to have a hefty payroll and people behind the desk, walking people around to an apartment and talking about, the school system, or, the kids in the neighborhood or monkeying around with a pool or anything else that attracts people to residential real estate or an office building that's close to X, Y, or Z. We just need to be in a 5-mile radius of folks. And as Scott mentioned, it's got to be secure, it's got to be clean, and it needs to be easy to be able to rent. And so we're automating our facilities as well. Not all of them, but if it makes sense. We have unmanned facilities in our greater portfolio. We have some facilities that have a kiosk, so as overflow if the manager is busy, and heavy use of a call center. So the name of the game in self-storage is this is a commodity. When people need it, they need it. And when they need it, they call or they go online and they begin searching. And so if our website, our website does, but if a self-storage website facility has the ability to reserve a unit or rent a unit online, and all the pictures look like it's safe, clean, and secure, and it's within the 3 miles of that person's house, they're going to check this off their to-do list of items. If they can walk into a facility and rent a unit just as easily as using, their coffee app and picking up a coffee and avoiding the line, they'll do that in self-storage as well. It's not a lengthy buying process that people go through, and so we just make the friction just less. And very simple and easy for people to be able to take care of this one task that people, again, need to do, not necessarily because they want to do it. We have the ability to remotely manage our facilities. The head of our operations and management oversees our properties and is obviously looking at the numbers, but we have the ability by way of the security cameras and what we have on site to not only monitor what's happening in the office, but our facilities and also the gates. Our property management software is very smart. On the 6th of the month, we have the ability to lock people out of their units and out of their the gates. And if they pay and when they pay, then we can unlock those. And so not all of our facilities have all of the same or even all of this technology, but as we get, depending upon the site where it's located and the demographic, we're adding and many times retrofitting our facilities to have the remote management. In some cases, we're adding fencing and electric gate where there wasn't one in the past, and giving access by way of their phone and or key fobs. So all we're doing is, it may sound like Scott and I are really smart, but we're just taking advantage of the technology that's out in the marketplace and that is available in self-storage, which allows us to be able to remotely manage, to do it more efficiently and without so many man hours, reducing that payroll, which just improves our returns. And there's not self-storage is, again, a pretty simple, predictable business model, pretty static. Not a whole lot of new technology or innovations coming into the industry, but this has in the past. It has been really, truly the ingress, egress into a facility and the ease of management, and reducing the management hours of having to walk somebody around a facility or open or unlock a unit once they pay physically, manually. We have locks that operate off the key fobs and wireless to be able to get in and out of our units now, which just allows us to be able to grow and amass thousands of units, be able to manage them all from one command and control center. Our websites and the industry has really come a long ways in terms of the ability. And Scott, correct me if I'm wrong. I know we talked about 80% of the folks that rent our units are females, but 80% of our rentals are also roughly across our portfolio now are utilizing phones to be able to rent a unit. So do you want to touch on that for a minute?
Yeah, and the biggest thing now is everyone has a phone. So geofencing, a lot of technologies that have been used in the airline industry with pricing, with local retailers like Starbucks and some of the bigger guys when it comes to attracting customers that they know are in the vicinity, is used. And it's great that we have a local type of business. People don't drive 15 miles to come rent a storage unit, right? Our market is really 3 to 5 miles, and that's super definable, either by a drive time or by a radius. And we're able to use geofencing and new technology to really manage both the marketing and who we're hitting, as well as how we're putting forth that price, and then hitting them again with a revised price. Things like that have really helped to put us to the top of the list in that market. And then you have, a mom and pop down the street that, Joe and Darlene own, and they don't know what geofencing means. And that's our competitor. And sophisticated owners, we only take up maybe 60% of the market. The rest is straight mom and pops. The REITs take up about 12%, maybe 15% now with a lot of consolidation happening and much more to still come. So hope that answers that.
And that is our business plan. There is the great scale up, and that is what we're best at. And that's that we are poised to continue to grow and continue to grow our portfolio and scaling up to become REITs like. We reverse engineer what they're doing and have been following that business model for a number of years now, and looking forward to to what we're seeing in 2023. So here's a piece for those of you that, and I'm sure William and the rest of the folks have talked a lot about this, but from our standpoint, Scott and I do have a lot of experience, and we have a lot of experience with working with passive investors and equity partners that come alongside of us. And so for you, when you're looking at sponsors, when you're looking at folks, syndicators to invest with like ourselves or anybody else, there's a number of things that is important that you should be looking at. First of all, is overall company structure. First of all, do they have a company? There are many folks that are out there raising capital that just hang a shingle out, meaning on the web, and stating that they are taking capital and equity partners that really don't. Property management, I think, is probably the bigger piece. As you grow and scale, we've learned, and other investors learn, that you can do it in-house in the beginning. If you're going to begin to expand geographically, it just makes sense. There's really no way to do it without third-party property management companies. However, at some point, you need to bring it all back home, because nobody cares. No property management company cares 1% as much about the profitability or the net operating income of your facility as you do. Property management companies, let's face it, they exist to generate fees, which means a higher expense to us as the sponsors and the owners. And so just as soon as we could bring that back in-house and become more vertically integrated, then yeah, we're driving income regularly. We're driving higher, and we're driving expenses lower, utilizing technology and working with the folks behind the desk, instead of just assuming that the management company is also honing the scale skills of the person behind the desk and watching every penny that comes in, which has also allowed us to shine and to be able to produce some returns that quite honestly are the envy of our industry right now. The due diligence that any sponsor or investor takes, that is something that you want to look into. We have an investor portal that I'm sure many of you are familiar with, and in which anybody who is interested in looking at our projects can go into the portal. We have a template that we've honed over the years, and very easy to read and understandable terms for our due diligence. So our investors, our equity partners, folks that come alongside of us, they can see the exact same set of due diligence docs that we look at when we are investing in a property and a project, so that our investors can do the same due diligence on us and on the project. Also, we have multiple attorneys, and much to Scott and I's dismay, the list continues to grow. We're thankful for our attorneys, don't get me wrong, but as we continue to grow, we realize things get more complex, but we do have multiple layers, and we have real estate attorneys that look at our contracts. We have attorneys that look at our deal structure, and then of course for the SEC side, we have multiple attorneys that are looking at and setting up our operating agreements and our private placements, and of course our fund, and making sure that we are in compliance. And if there's other folks out there that can't really answer that question well when you begin to ask them what their legal team looks like, and maybe you may want to dig into that a little bit further. Insurance is the best way to stay out of trouble, period. We carry a lot of insurance around here, not only on our properties and our projects, but we also carry it at the corporate level. And then also we have key man life insurance for the 4 partners within the Tricor investment group. So that if the 4 of us get hit by the proverbial bus, then our investors are made whole. And that is something that we've learned from the one percenters out there, with some of the other, the really large, the public REITs are doing. And so we decided to implement that as well. So at the end of the day, our investors are protected, and our properties and our projects are protected. Same goes for accounting. There's a few places I think that you should probably not skim when you're building your team and that includes your personal team. You don't want the cheapest doctor. You certainly don't want the cheapest brain surgeon. You don't want the cheapest attorney, and you don't want the cheapest CPA or somebody that you found online that just happened to or just got their degree in accounting. So that is a lesson that I think many people learn the hard way, and that you learn as you grow. And so we have pulled the Band-Aid off, and we've gone with a very large reputable firm that has access to multiple folks and resources, so that we will never have that issue when it comes time to, well, never say never, but when it comes time for looking at tax returns, getting K-1s out to our investors, we have taken a very thorough approach to vetting those folks. Also, asset management. When we look at asset management, is there a person or a team dedicated to driving the performance of the portfolio? Many times there are folks that it is the syndicator, the sponsor, if they're smaller, that is in charge of that. And well, if they got multiple hats to wear, they may not be, they may have moved on to the next project, raising capital for the next one, or looking for the next deal. If they don't truly have a team where there's an asset manager that is driving the performance, well, who is? And if we're going to produce the returns to our investors, speaking for Tricor, we have dedicated asset managers that are driving the performance of each and every one of our projects. And that includes fund management. We have investor relations representatives that are also managing our clients that invest with us, and getting the communications out, answering their questions, helping them to move funds around, and also working with them during tax time. We have multiple guarantors within our organization, so we have the ability to not only take out loans, which is a low cost of capital going into our projects, but we don't have capital calls in any one of our projects either. We have never had a capital call, and it's built into our operating agreement that we can't ask for a capital call from our investors. So if for any reason, and it never has, we have a shortfall because we didn't raise enough money, or there's something unexpected, or we didn't do our due diligence, we won't have a capital call, but we have the ability to secure another loan if need be. So we structure our projects with equity and debt, because we have the ability to go out and get debt, and we have the ability to go out to get inexpensive capital. And then we layer on the private equity from folks coming from different custodians like Camoplan to invest alongside of us as well. Tenure, I think, is key. In, there's a whole lot of folks that are raising capital when you're looking at sponsors that you're evaluating. There's a whole lot of folks that got into real estate investing and began raising capital since 2010. And speaking for myself included, there's a whole lot of folks that did very well in the past several years. But we've also had a pretty strong bull market, and a big sale and a big wind in our back. And so 50% of the success of many folks out there was a gift from the market, and some folks just aren't all that great. So it's good to see that, if you're evaluating sponsors, have they been through a recession? How did they do? What were their projections across their portfolio that they sent out to their prospective equity partners and folks that partner with them? And then what did they return to them? Did they hit the marks? Did they fall short? Did they exceed those projections? These are all questions that you should be asking and evaluating when evaluating your sponsors. Are they utilizing consultants? Scott and I get really excited about our deals. And then many times, once we have our feasibility study consultants come in, we call them the black cloud. Many times they'll come in and they'll poo-poo, and every once in a while they'll tell us that this is a deal you probably shouldn't consider. Thankful for them, because they point out some of our blind spots and maybe quash a little bit of our exuberance, because we're deal hogs. We like to grow, and when we find opportunities, we get excited. But they're just that. They're opportunities until they turn into a deal, and until we underwrite them, and until we get vetted and verified by our consultants. And so if you're investing with somebody and you ask them the question, well, who is? And an appraiser could be a consultant essentially, or a consultant that does feasibility studies. But we have consultants that do underwriting for us, and they look at the numbers and they say yes or no. And then we have either appraisers or feasibility study consultants look at it. So do folks that you're looking at have that extra layer of protection?
And let me mention,
yeah, go ahead, Scott.
let me mention one good thing that we do is we do it all internally. I want to mention that too. So we do all of that underwriting. We do our own pricing studies and saturation studies, but we have these health checks. And as we've seen larger companies, REITs, they do the same, right? They have these fail safes where we aggregate information, we put the data in there, we put the statistics in there, we do our own pricing studies, but we also have, and on top of that, sometimes there's things they miss or we miss. For instance, we send out a company called Dynamic Solutions. They go out to the properties, they do the inspections, they do it all for about $2,000. it's a savings for us. It would cost us $3,000, $4,000 between all the time and money and resources we'd spend. And they send us a 30-page report of every single unit, what's going on in that property, what looks good, what doesn't. And I don't want to belabor this, but we have quite a few consultants, but they really help to provide another layer beyond how we are vertically integrated, just to make sure that we're all on the same page and we're not making growing too fast and making mistakes in analyzing data.
There's wisdom in a multitude of counselors, and we all recognize that within Tricor, and we lean on these people heavily. We do have our own investor relations department and individuals that again work with multiple custodians. We're all familiar with Camaplan. We don't have favorites, but let's just say that Camaplan is at the top of the list of folks that are easy to work with the investors that are coming into our projects as well. And then ultimately, when evaluating a sponsor, what's the track record? How strong are they? Again, matching those projections that they put forth for their investors, and then actually meeting, exceeding those expectations. And how long have they been doing it? Have they been through a recession before? I can't stress that enough. I feel that there's a whole lot of folks out there raising capital, but if you can't see, if you've never been through a recession, you can't see that far down the road. And I think success is a horrible teacher. And there's a whole lot of folks out there that have had a lot of success that have never been through a recession, and just haven't learned the lessons that we have. And that is a feather in our cap. And that's where I believe across the landscape that I will put Tricor, Scott, myself, Ken, and Larry in the 1%er club. So we do have that experience. We've got a number of partners. We've raised over 45 million. We've got $160 million in asset under management right now, and that ebbs and flows because we do within our fund, we're actively buying and selling all the time. That's what produces the returns. We have also direct investments or private placements in which we may be into a project or a portfolio of 3 projects, 3 facilities that we may sell out of in 3 years. And so we have a multitude of ways that people can invest with us and projects that we invest in. We do conversions of old dark vacant industrial buildings or dark boxes, as we call them, dark big boxes that we convert. That is, I don't know if I'd say it's our specialty, but we're pretty darn good at it. We've done a number of those in addition to existing and development. 41 projects, call it that, and but closer to really 50 when you look at everything that is coming down the pike that really hasn't come online as of yet. So those numbers are changing because we're moving fast, but at the end of the day, there's a lot that can be used with experience in our day-to-day. So our acquisition criteria and looking at existing facilities, we're focusing on B and C class, meaning not way out in the middle of a farm field, but we're in some secondary and tertiary markets. They're value add facilities where they're not professionally managed, and there's usually high vacancy and just room for improvement. So we can take it from a B to a C, or from a C to a B, or from a B minus to a B plus. You can't really take a B to an A. That's just not possible. But always, making improvements. That's been the business model from day one, is only buying value add facilities. We like high traffic counts. It's not necessary because, as Scott mentioned, most people find us by way of a phone. But it is helpful to have that awareness. But studies are showing now that we rely as an industry less and less on traffic counts. It's really only for familiarity. We focus on underserved markets, which means, as Scott mentioned, we are looking at a number of markets, and truly within a market, a 5-mile radius, an area that is underserved, meaning there's a market equilibrium somewhere around 6 to 8 square foot per person. But we are looking for those markets that may be in the 4 to 5, or at the very least, if it's 6 to 8 square foot per person, but everybody's full and they're raising rates. Those are the types of things that we do. And so, Scott, I'll let you talk to the rest of these. This really falls more under the operations side and in your wheelhouse, which is on the acquisition side.
Yeah, I think you mentioned a lot of it. Back to the business plan on each asset, right? Is depending on the market, depending on what's climate controlled, what's non, if there's parking, the market will basically dictate from history what fills up and what stays full, what's needed, and how much of it's needed, right? And so there's almost a science to that leads us to all these things, right? It leads us to the first criteria are the first 4 or 5 things, right? That's what we look for. The expansions, the conversions are great. But we got to be able to pay debt, and especially in this market right now with financing the way it is, All my lenders, all they want is a debt coverage of 1.25. They want us to pay their debt bill undoubtedly. And the great part is we as a property type, we're looked at as a safer investment than multifamily because our break even's much lower. There's a lot more cash on the bottom line, especially if we keep it leased up. And during even during COVID, amongst our portfolio, I think we had about 30 days that was rough. Of that 30 days, we went back the following 30 days and was able to collect a lot of the rents that were back due. We wrote off a lot of debt for that 30 days, and that was the hardcore lockdown of the 15 days. So, and other than that, we got right back up. Everybody got back in communication with the tenants, and we really didn't have more than one quarter worth of stabilization. And it's because, we stay on those delinquencies, back to this final point of management. We stay on the delinquencies. We have that personal interaction. We have that culture. I go back to that, right? We change the culture in a lot of these properties. The culture is typically messed up. It's owners that don't understand things. And very rarely we'll find a property that the culture is good and it's just a good buy. But a lot of these is buying it right, managing it right, and really, running it. It's not a very complicated business, but there's a few really key elements like collecting rents, the ease of paying rents, and finding those efficiencies and expenses.
Absolutely. And again, at the heart of what we do is giving back. We have been very blessed in our organization, and we give back corporately 10% of our profits. Goes back to the areas in which we are building houses. And to date, we built 26 houses in Ensenada, Mexico. We take teams of our staff, our vendors, our partners, really anybody that wants to go on an all expense paid mission trip with us for 4 days, a family friendly, as you can see, mission trip. We build a house in 2 days. It's a 4-day trip, 2 days of travel, and we build a house in 2 days, and then we hand the keys over to a deserving family who has been vetted through our partners, YWAM, Youth with a Mission, and we do most of this in YWAM, Mexico, and getting ready to head back coming up this June as well. So 2023 is still looking strong as we're seeing from Yardi Matrix, who we rely on for our stats. We're still seeing high year-over-year rent growth in the Southeast, which is our core focus, and in all the right sizes of units in the facilities that we are looking at. And so very excited as we've seen once again, Scott and I are biased, but not biased. I think if there's another widget out there, another form of real estate that would outperform self-storage, we'd be over there. And if there is one, let me know. But we haven't found anything, and that's why we stay in self-storage. And so Wall Street Journal, again, many of you are probably here because you've seen or heard. All you need to do is look on the interwebs and type in the best performing real estate asset class, and especially during a recession, and all everything points to self-storage. You'll just find it. And, we're seeing U.S. inflation still high, and consumer prices jump. And so I guess the awareness is where we're telling other folks, our investors, many of the folks that are already investing with us, or anybody that may have some money on the sidelines, no matter where you feel inflation is at right now. And again, this is not, we're very clear of our ground rules here and not stepping any toes, as William has mentioned. But if you're sitting in cash right now, I think it's pretty much public knowledge that with inflation where it is right now, you're going backwards. You're losing wealth. And so regardless of where you invest or what you invest in right now, you should get your money into play, just because inflation right now, the higher it gets, if your money is sitting in cash and you're sitting on the sidelines right now, you may want to look to invest in something. We like self-storage, obviously. And again, the reasons why Scott and I and our investors are in it, because the 25-year average annual returns for self-storage is 16.85%. Industrial is at 13%, healthcare at 13%, multifamily at almost 13%, retail at 12%, office at 12.15%, S&P 500 at 7%. The downside protection, as we saw, even from the REIT sector, at the worst of the worst time, self-storage is only down 3.8%, and multifamily double that. Multifamily always takes a hit during a recession, as we know, and retail certainly, as we hit into a recession, people stop. So the retail sector way down. Office buildings, same thing in the S&P 500 took a hit, 21.1% from 2007 to 2009. By way of comparison, $100,000 invested in self-storage in 1994. Outperformed multifamily by 2,215,000. So not only did you get your return, but you would have got an extra 2.2 million if you invested in self-storage, and the S&P 500 by 3,494,170, says NAREIT, which tracks all of the commercial real estate investments trusts out there. So not to toot our horn, but to toot our own horn. Scott and I, we've been doing this for 16 years now. That is taking in private equity partners by way of Reg D 506Bs, 506Cs. And the average projected returns that we put out to our investors has been just a little north of 26%. And our average returns through the recessions and for the past 16 years has been 37.4% return to our investors. And so we've doubled what the REITs are doing in the industry at 16.85%. And that is because of the approach that we have taken, that we just laid out. So if you have any questions and you are interested, we always have active investments offerings. We have two that are active right now. It is one is a fund. It is a blind pool self-storage fund that has about $600,000 left with a $50,000 minimum. And we also have about $1 million left to invest, rounding out a $9 million equity raise in a portfolio of 3 facilities outside of Louisville, Kentucky. And again, our average returns are anywhere from 18 to 22% projected on those projects. But if you have interest in those, contact info@passivestorageinvesting.com. Julie in our investor relations department will get any information over to you. Or if not, again, as we stated, you should be following syndicators to see what they do. Just compare, log in. It costs nothing. It does nothing. We'll make you aware of investments that come down the pike that you can watch our webinars, but poke around our portal, pull down the due diligence, take a look at how we evaluate, how we analyze, as Scott said. Look at our due diligence and compare it against who you may be using now, or if you're new to this game of looking to invest passively, then at least you get a benchmark. I feel a benchmark. We do tend to set the standard in terms of a baseline for the amount of due diligence and what we offer and give access to our investors who are looking to invest alongside of us. So with that, Scott, I'll let you add anything else before we open it up for Q&A.
No, I'd say, one other thing that we pride ourselves on is the communication. And I think this last slide's kind of speaks to that is, Scott and I are thoroughly involved, both with the equity and debt structuring, with those business plans on the properties. I really work in acquisitions a lot. So I get to look at every deal that cross our paths. Since we've really, I'd say in the last 3 years, we've looked at more than 7,000 deals. We look at a lot of deals per day. I probably look at personally 7 to 10 deals a day. And so, we are very selective. We've only done 50 projects and we've looked at 7,000 deals. So that gives you an idea of what it takes to finally close on a property here. And to make sure that it's a solid investment for our investors. And like Scott said, we don't have capital calls. And that's a reason that we're setting up a 3 to 5 year business plan. And typically we're selling properties in half that time for more IRR and equity multiple than we even indicated in the beginning. So that's another part of being conservative, because you never know what the next year is going to bring, or next couple of years with the economy, interest rates. And so right now we are making sure we have low leverage, making sure we're poised for tumultuous times, and great if times turn around quickly, interest rates sling down a little bit, cap rates compress, we'll be in a great spot. But if they don't for a year or two, we'll also be in a good spot because we've already planned for that. So I think that's kind of the biggest thing, I think. And back to communication, from top to bottom and back and forth, we have solid communication from our stores to our GP, to our district managers, regional managers, all the way up to the corporate heads and partners, understanding and knowing what's going on in all our properties.
Great.
Great. Thank you both so much for, preparing this presentation and taking the time out of your days to lend us your knowledge and share us your expertise. So like you said, we're going to open it up for questions now. I see some are coming in now, but highly suggest everybody in the audience now use this time while we still have both of the Scotts here to ask any questions. So we'll get started right away. First question we have is, what is depreciation rate on self-storage? Is there bonus depreciation in self-storage?
Yes, I'll take that one. Yes, there is bonus depreciation. There's also ability to have accelerated depreciation. We typically we're going to have larger depreciation when we're holding it longer. There's a kind of a net present value calculation you have to do on what you're going to spend for the cost segregation study. They run anywhere from $5,000 to $8,000, depending on the size of the property and magnitude of the inspections and of the study. Typically, we're running, I want to say, 12 to 15%. So that kind of gives you a general idea, but it changes on the property. We like to be able to define a lot of those allocations up front through the actual purchase agreement. So that helps us lead us to an ironclad ability to depreciate as much as absolutely possible. We don't try to push it too much because it is the IRS. We don't want it to be known as through the IRS as somebody that's pushing those lines. And it changes on each property. And if you're able to take that depreciation through a qualified plan or not. So there's a lot that goes into that. And as I said before, Scott, we are very available and can have, calls scheduled to go through some of that in a little more detail.
Perfect. Thank you. I hope that answered your question, Jeff. Next question we have from Matthew. Did you say minimum was 50,000 to invest? Obvious statement, but I think you said you work with investors at Camaplan. What is the hold period for an investment?
The answer is yes and yes. The minimum is 50,000, both in our current offerings, which is the Tricor Storage Fund, as well as in our LaGrange portfolio just outside of Louisville. We do work, and again, we work very well with Camaplan. They're very easy to work with, and not all custodians are treated the same. And we're not just saying that because we're on here with Camaplan and William. I think Scott and our team would state the same as well. And the whole period for an investment, it varies, Matthew. In terms of our fund, we've set it up for 5 years. And that is where we feel that for the properties, in order to acquire the properties, the number of properties that we want to be able to build value into those and then exit. And for the combination of the cash flow, the preferred return to get the IRR to our investors, we felt that was 5 years. And maybe a little bit of a rabbit trail, but we've already sold a couple of the properties within that portfolio and just washed that money, put it back in. And so our returns are already boosted within the fund. Our project outside of Louisville, we have defined a holding period. And if we can exit and we can get a higher IRR for our folks and not take a huge hit on an equity multiple, then we will do that. We're always looking to mitigate downside risk and also maximize the returns for our investors. And so if we've set an existing portfolio of facilities to say for 4 years, in order to do maybe some expansion, to raise the rates, to get the accounts receivable in place, raise the rates of the existing clients. If it takes us 4 years to do that, okay, and then exiting when we're in an environment in which the interest rates are lower and cap rates are lower, then that's what we'll do. We'll write it out for 4 years. If the interest rates go lower sooner, if we achieve our goals quicker, then we will exit. And if there's a higher IRR to be had by our investors, then we will do that, because otherwise holding just might, the longer we go, then all that does is just erode the internal rate of return for our investors. And so this is something that a good owners, good managers, good syndicators are looking at on a regular basis. This is, how is the portfolio performing? Let's do an internal opinion of value. Can we sell it now? Where do we feel cap rates are if we were to put it out to sell? And if so, what are the returns? We're percentaging that back into our investors. And so that is an exercise that we go through on a regular basis to look at. So I know it's a long-winded answer to your question, and we can answer any question with it in a simple word, is it depends, but it depends. So we've exited most of our projects ahead of the projected time period in which we stated that we were going to exit, at least speaking for ourselves in Tricor.
Great. Thank you, Scott, for that answer. Thank you, Matthew, for the question. I would be remiss not to ask you for our audience in here today and the people that will be watching in the future as a self-directed custodian, what has both of your experiences been, philosophy with, and preparation for using qualified funds for these raises? How has that been?
Gosh, I oversee most of the investor relations, so I'll speak to that first, and then have Scott answer. And I think we, like any good vendor that we're looking at, we usually for ourselves we always look at three. If we're looking at a general contractor to build, we want to have 3 bids on the table. If we're looking at software vendors, we want to look at 3. Well, we don't have the luxury of doing that when it comes to a custodian, because our investors come to us and they're already either they have a plan set up, or in some cases we are directing them somewhere. And so we find out by way of experience and working with other custodians how well they've done. But if we don't have experience in that, then we will seek within our investor pool a way to be able to get reference. And we also work with other syndicators, and we'll ask them how have these custodians been to work with in terms of reporting, getting information back. And for us, selfishly, it's releasing the funds. We have run across some custodians that have been very difficult to work with. We have a timeline in which we need to fill up our, have our capital raised by a certain amount of time, or else we miss out on the deal. We fall out of contract. And there have been some custodians that I'm sure it's not intentional, but have made it very slow and difficult for the investors, their clients, to be able to get a hold of their funds and to invest in our projects. And so we look for, again, least amount of friction as possible. That's one, and that's what we've run into with the Camel Plan. That's why I say we're at the top of the list. For me, that is number one, is that we don't have to continue to go back to our investors, or they're not complaining to us or bellyaching to say, hey, let me in, I want in, but my custodian has my money hostage. We have never heard that from Camel Plan. And also there are some custodians that have maybe some overburdensome reporting requirements, which has our investor relations team spending time spitting out and reporting and sending documents back to the custodian on behalf of the investor that just may be a little egregious and a little overbearing. And so in that instance, we're not going to necessarily refer our investors who don't have a self-directed IRA fund in place. We may not send them to that custodian as well. So those are probably my top 2. So Scott, what would you add to that?
I don't know that I'd add anything. I think you hit it nail on the head. For me, I'm the deal junkie as well. So timing is huge for me, and seeing it all come together there with our partners. So speed of execution's a major item there. We have a great investor relations department that's able to work through the nuances that come up, and we also have, I think, probably what, Scott, 60%, 70% of our investors are through some type of plan or IRA.
Yeah.
And so we're used to it. We're used to turning around those fair market value valuations each year, filling out the forms. So we get it on our end. And I think just speed is one of my biggest things of being able to execute a deal and relying on our following of investors to come along with us and partner with us.
And
Amazing.
William, I've been speaking at your events and working with several folks higher up in the organization, and I'll just add that we just like you guys. We just like doing business with you.
That's very kind, and it's a mutual feeling. And when it comes for the investors, the first thing is the relationship and trust they can form with the investment provider, what they're providing, who they're working with. And then when it comes to using qualified funds, it's 3 parties that have to gel together, and it's 3 parties that have to pull their own weight. And it's great to have investment providers that are prepared, that are knowledgeable about qualified funds, and it just makes it a lot better for the investor and all parties involved. So that's been our experience. So it goes both ways. And I know we started a little bit late, and we're already past that 1 o'clock time, but I do have 2 questions that I'll ask just for people that are going to be watching this in the future, the recording. One question I get a lot with different investment providers recently has been this whole presentation was going over how the investment category or the asset class of self-storage, how it's pretty much built to withstand the effects of recession, but even with being in such an asset class, has that with the recent events, has that made you and you guys over there change anything up? Has your strategy differed at all, or how have you guys reacted to what's going on recently?
I would say, first of all, we don't change a whole lot in terms of our strategy, which means that, first of all, we're looking at the numbers. I mean, real estate is math, and the math that goes into this, dictates and determines, there's other factors as well, but when we do our underwriting and our financial analysis, where is it now? Are we paying a fair price, or are we getting a good deal on this, or is this just opportunity? And where do we take it? And that is determined by our capital stack, our cost of capital right now. And so I think where many people miss it is they don't know how to make those calculations. And for us, we don't pivot. Our business plan is the same. We may have a little lower loan to value, and our interest rate is higher, but when we plug in a higher cost of capital, a higher amount of money, well, can we afford to pay this? Does the price still match, and does the model still work? The model doesn't change. We just change the inputs, and our model and our financial analysts and all the conversations that we have surrounding this project, factor into whether we move forward or not. And so I could say, I don't want to make it sound like we're one dimensional and that's all we look at, but I think that's where so many people miss it, where they get scared, or they sit on the sidelines, or they start pulling different levers when the deal either makes sense at the new higher cost of capital, and maybe the seller's expectation of price is off and he hasn't matched the market yet, and we just have to pass and come back to him when he's either realistic, or we find another way to get creative and reduce our cost of capital if we really want a project. But fundamentally, William, it doesn't change. We have a solid plan and a solid process that we go through. If the input changes, then by going through the process, it'll tell us whether we move forward or not. So I don't want to oversimplify it, but I'll just let Scott then add color to that.
I'm going to make it even more simple. Really, it comes down to that math equation, like you were saying. Over the last 6 months, it's been pretty tumultuous with the banks. October, November, December of last year was really awful. We just had a lot of banks retrade on us. So I think I had 4 different term sheets or commitment letters that the bank said, nope, I'm not interested anymore because of the volatility of the rates. So I think we're through some of that. Those were very hard times to find those loans. Fortunately, at some points in time, we were able to pay cash for the properties, go back when things had settled down, and refinance them early in Q1 of this year. So we changed strategies up, right? And that takes us to a lower overall loan to value, loan to cost, which is also, like I said earlier, we're getting ready for hard times just in case. And if things, continue to go and just kind of be level and don't change much, then we're going to continue to buy and continue our value add strategies, which aren't dependent on an interest rate, aren't dependent on really the market changing, right? We're just changing the property. There's just dollars sitting there. Some properties we buy, there's hundreds of thousands of dollars of rents that people are not collecting. We're just purely going in there. We're collecting the rents properly. We're making sure there's not 22% delinquencies. Our delinquencies should be under 5% by the 5th day of the month. So we have these kind of little coined phrases around our company. If delinquencies aren't under 5 by day 5, you're going to start getting calls from corporate about the issues, about that not being in line with the way we run our ship. So, I think just that loan to value, loan to cost, overall, our portfolio runs right around 60% at this point. In past years, we've run it up to 70-75%. And a lot of those were, heavy value add or construction or conversion deals that had a lot of appreciation on the back end.
Amazing.
I started at 8% interest rates, and so this is nothing new.
Great. No, I love those answers. I asked these questions a lot, and that was probably the most thoughtful and explanatory answer I've gotten so far. So thank you for that. And I'll say the last question is, we're going to close out. So if you have anything that you guys are working on, anything you want to leave the viewers off on that are present now or maybe watching in the future, what would you want to leave them off with before we call it?
Sure. Go ahead, Scott. You take that.
I think, we're just excited to have, to be working with Camaplan and really have a relationship with a company that has as much integrity as we have. We were able to move really fast. We expect Camaplan to move fast and has in the past. And that's, I think, why we like each other so much is we're a professional shop, vertically integrated, and and speed and communication and integrity are really some main things that we hinge all of our vendors, consultants, and people we work with as kind of that first look. And we don't do business with people that really don't have that same structure or culture. And so we invite, everybody to come along, check our website out, schedule a call with Scott or I. We both have assistants to help with that. And yeah, we're excited to roll out some new funds. We may have another blind pool fund coming out, another couple of portfolio funds. And so stay tuned on, exciting funds coming out of Tricor.
And we do have the two available that I mentioned. We have a portfolio that still has a room for investors that'll be available for a while, as well as our first fund, the $25 million Tricor Storage Fund 1. There is a room in that one. So if anybody is interested, by all means, as Scott mentioned, take a peek at our website, contact Julie. We'll give you access so you can look into both of those, vet them, and we'd love to have you come on board.
Amazing. Thank you. And on behalf of Camaplan and I'm sure the viewers in here today and the people that will be watching in the future, I want to thank you for lending your time. And if anybody watching this now or in the future has any questions about what was discussed on the self-storage side, please use the contact information on your screen. Like they said, reach out, get your answers. And if you have any questions about how it applies to self-direction, you want to get started, or you need any help hand-holding, give us a call at Camaplan, shoot us an email. We're always happy to help. And I hope Scott Day and Scott Myers, I hope you both have a great rest of your day, and everybody else in the audience, I hope you do the same.
Great. Thanks, William. Thanks, everyone.
Thanks, William.
Take care.
Thank you.
Bye, guys.